Okay. Good morning, good afternoon, good evening, and welcome to everyone for session. So the embedded finance today we have the embedded finance panel, and obviously this is one of the last sessions of the day, and there is good reasons for this, right? In many ways, the embedded finance is about enabling the customer journeys and customer experience in a transparent, invisible way that encompasses different aspects of strategy, business models, innovations in data, developments in technology with AI, ML, and Gen AI, and more. Architectural models, API, microservices, cloud, and so on. So we talked about all of these in the previous panel. So now it's time to kind of bring it all together and talk about this in the embedded panel, about the embedded model, right? So, and we have two experts on the field to talk about that from a strategic standpoint. I'd like to welcome Paolo Sironi and Huw Davies to this discussion. Paolo, Huw, welcome.
Thank you. Buongiorno a tutti. Actually, buonasera.
Thank you.
Yeah. So let me introduce both of them here. Paolo is the global research leader in banking and financial markets at IBM, the Institute for Business Value. He's a former startup entrepreneur focused on digitalization of wealth and asset management. He started his career as a quant leading risk management organization in investment banking. Paolo is also author of professional literature about finance, banking, and digital innovation. His latest Amazon bestseller, Banks and Fintech on Platform Economies, Contextual Conscious Banking, explores how platform theory, born out of financial services, makes its way inside banking to radically transform the way firms do the business and engage with clients. We also have Huw Davies, the co-founder and CEO at Ozone API. Huw has over 25 years of experience in banking, leading payments globally at HSBC and former head of digital payments at MasterCard. He led the growth of open banking in the UK as ecosystem development director at OBIE. He has successfully built high-growth businesses both within large corporates and as standalone startups. And I'm your host. My name is Pradesh, and I work as Associate Director, Business Analyst at FIS. I worked in payments area for the last 24 years, and our group is responsible for keeping the FIS payments products and applications and our clients compliant with payment networks. So I'm also part of the innovation task force at FIS that oversees programs like this, and I'm very passionate about innovation myself. So welcome again, Paolo and Huw. Paolo, let me start with you. Let's go back in time a little bit so we can kind of set the context for the discussions coming up, right? So when you think about systems, like 15, 20, 25 years back, we had large monolithic systems that kind of barely talk to each other, right? We had the core banking systems, we had lending systems, we had payment systems, the customer database that either stood as a standalone system or just communicated to what was essential, right? So when we think about that and now, what are the factors that you think that has enabled the journey from monolithic systems to kind of embedded systems now, or the experiences that we would like to say that terminology, right? So what are some of the core ingredients that make this happen now versus earlier? I mean, I understand there are multiple factors, but maybe just the top 3 or 4 that comes to your mind.
So a very important question, and to answer, I will want to make parallels to different constituencies compared to where most of the attendees work in. But I believe you will appreciate in a moment the reason why I'm doing that. Basically, starting from European perspective, leading into what you are also doing in your regions in India and beyond in Asia Pacific. And the reason I will start from Europe is because in Europe, most of the weaknesses of the financial system, as we used to know it before the global financial crisis, have been exposed by a series of events. It's like a perfect storm. So the default of Lehman Brothers created an action from central banks to lower interest rates that in most European countries became negative on the old-term structure. And at the same time, the central banks had to lift the cost of capital, raising it to a much higher amount. Now, the consequence is that it happened across the world, but in particular in Europe, banks became incapable to remunerate the shareholders with the pillar of the profitability that is and used to be the interest rate margin, so the credit operations. And that's the reason why we saw a lot of banks moving towards investment management, fee businesses that can be payments and wealth management. But payments in Europe are low margin compared to other parts of the world, like in the US. And investment management is also very competitive because of passive investing, transparency regulation. So all in all, it happens that the economic model under which banks have been working before the global financial crisis stopped corresponding to the prevailing macroeconomic conditions and the competitive landscape that started emerging after digital transformation became mainstream. Now, in 2019, Mario Draghi, the former chairman of the European Central Bank, was addressing the audience in the press room of the ECB 2 weeks before he left office for Ms. Lagarde. And a journalist asked him if the intervention of the central bank post the global financial crisis would create the next systemic crisis, because essentially the profitability of banks is really and highly dependent on the macroeconomic conditions in which they operate, also in India. Typically, banks are clustered around a certain level of profitability according to where they operate into. And Mario Draghi, responding to the journalist, said, well, I know that banks would love positive rates, low cost of capital, but essentially said, banks have to adjust the business model to the digitalization of financial services. Now, when central bankers talk, every word matters. It didn't say banks have to digitalize existing business models. That means you lift and shift your monolithic architecture on cloud, and then everything works because maybe you get cheaper cost, right, and you can still operate. No, the focus was on the adjustment of the business model, because without that change, the benefits of digitalization will not kick in. Basically, return on investment will not be generated. So then the question is, what are these business models and how do they interact with the way technology and architectures have been built? Now, going back to the European Central Bank that had to deal with these problems, again, because European banks are one of the weakest in aggregate of the planet. So there all the weaknesses are exposed. So the ECB said that there are two ways banks exert market power, so they become or remain profitable. One is information and one is in communication. So they need to excel in both. What is information? Information, they say, is the core banking. So the data which is inside the core banking of the institution, made of transaction information from payment or the adverse selection, basically the credit principle by which they identify worthy creditors and less worthy creditors. And they say, well, it is way too impossible for banks now to generate shareholder value by working with this data inside the core of the bank. So what they say is, well, they need to open up to the external ecosystem by leveraging open banking, open finance, or banking as a service in a way that new value can be generated at the intersection with other industries. And at the same time, they say communication is becoming very important, but communication is the interface. That means people talking to people. So the question becomes, how do I basically allow this communication, this channel of human relationships to be performed at scale for cheaper prices to justify more value that clients have to pay for? Now, information and communication, that now I made the axis of my banking innovation quadrant in my latest bestseller, B2B Fintech on Platform Economies, correspond to different ways of leveraging technology. Excelling in information means that you need to move from a monolithic core banking to a modular core banking or infrastructure, because that needs to enable the connectivity with distant ecosystems that have their own principles in the way they design the client journeys. So a monolithic way of working will not facilitate onboarding partners and creating solutions that need to be very timely, because use cases that you can scout out there in order to service their clients whenever and wherever they want needs to be generated very fast, because it becomes a very, very dynamic environment. And instead, communication means operating with artificial intelligence to me. So making sure that you can augment the capability of people to talk to people. But of course, that requires digesting data to a broader extent, data that come from core and data that come from outside the core. So again, the modularity of all of this is essential. Now, The combination of these effectively is the need to transform core banking to a different status. Without that, it will not be possible to basically succeed. But having said that, that doesn't mean that everything needs to be microservices or containerized. It really is a fit for purpose. There are parts of the business that are more apt to generate value by becoming more modular, and other part of the business that maybe can still remain in a state where it's like intermediate. So that's why it's an hybrid cloud type of capability that banks have to build, because they need to serve a variety of different use cases, some more internal, but many way more external. So the need for that is not the willingness just to be clean in the way technology is built, which is by itself a good target. The need really is a business need, because otherwise revenues cannot be generated.
Okay, yeah, thanks, Paolo. I think that's an interesting setting the context, right? In terms of the weakness in the European banks, in terms of lower interest rates, how the central banks, some of the policies from central banks through those low interest rates, and then the return of equity from the banking standpoint, the ROI, and then coming back to the piece about information, data and intelligence, communication, that's the interface modularity and some of those things. So that's an interesting insight. So let me talk about your book, Platform Economies, where you mentioned about business models which should transform from being based on products or outputs to focusing on results or outcomes, right? You stressed upon the importance of value with technology within the regulatory framework as a means of enabling outcomes for customers. So from an embedded finance standpoint, how do you see that business value is created? Like, if you can give some high level pointers, that would be great. Specific to a startup, how do you see a value can be created?
Yeah, I can actually respond to this question with a personal story to help you basically grounding it into something that you can understand quickly. But then you can go back to literature to read all of the other elements that I'm defining and detailing to identify those business models. But I start for principles. The first step needs to be done right. What you mentioned is the fact that we're now talking more and more about platform economies. The fourth industrial revolution is a data revolution that de facto is a platform revolution. So the question is, how you transform with technology a business model of a bank that typically is very linear, from the manufacturer, the product makers, to the distribution channels in front of the clients, into something where more operators are basically collaborating in terms of creating different solutions which are more personalized. One thing that happens when you think platforms instead of linear models is that the products per se are not the center anymore of the mechanics. Now, let me say, even when you think about marketing, many think that personalization means understanding the client, taking a bazooka and shooting the product that fit the client. Not at all. It will not work on digital. So the product itself is more, if you like, simplified, tends to be more standardized when you operate on digital. Something else is relevant, is the outcome. So you need to understand how to shift from outputs, distribution channels of products, into outcomes that are experiences, journeys, or advisory elements, and understand how to use technology to get paid for that element, because the value will be shifting out of the product into the journey. This is happening anyway, because products marginality in terms of profitability is getting lower and lower and lower as time goes by. So you need to understand how to get paid differently. Now, to explain this one, I give you this story. I did 2 startups in my life. My second one that I built in Germany in 2008 was dedicated to digital wealth management. It was bought by IBM in 2013. That's when I joined IBM. But before, in the 1990s, with my brother, I helped him to build the Amazon of Italy. And nobody laughs. I really wanted to do that because I thought, Pradesh, that I had the best products on earth. I had Italian fashion, I had Italian travel, I had Italian food, and I had Italian furniture, and I hope that appeals to the Indian as well. Now, notwithstanding at all of these best products on display, I did not sell anything. And there was a disaster, nothing, okay? But it was a good experience, and I thank my brother for the enthusiasm. But I learned one thing that is important here. And I learned that years after, notwithstanding I had a slick website, I had a good payment method with an Italian bank, Jeff Bezos was interviewed on 60 Minutes, and it was an old interview of the 1990s. And the journalist asked him, what's Amazon? Now, Pradesh, you're my age. You remember that at the very beginning of his journey, Jeff Bezos was primarily selling books through Amazon. So Jeff Bezos goes, I'm not the distribution channel of books on the internet. I'm like, he's not. Now ask yourself, is a fintech, is a neobank a distribution channel of financial products on mobile? Is the same question. And he said, I'm not the distribution channel of books on the internet, and let me explain to you why. So he said, the publishers are sending me letters today complaining that I don't understand marketing. Now, you call Jeff Bezos stupid, right? And the reason is because he said that I allow users to post positive and negative reviews, while the publishers say only post positive reviews so we can sell more. But he said they don't understand the platform dynamics, right? Because he said, my clients are not the manufacturers, those that create the products, can be investment products, insurance contracts. My clients are the users on the platform. They onboard on the platform, but they don't know what to do because they cannot take the book, smell the glue as I always do, look at the back cover page to see some of the reviews. So it's very complex for them to be motivated and act. So then he said, my role is not to be a distribution channel of books. My role is basically to advise the client on which is the best book to buy. And how do I do that? He says, positive and negative reviews are an element of transparency that motivates the client to act by themselves. Now, of course, I know that can be abused, so the regulatory perspective that I built is always very strong for financial services. But essentially, that's basically what he said. I am an advisory mechanism. So, and then he concluded, and then to me was an all. I said, only after I motivate the client, I use analytics, today we would say machine learning, generative AI, to propose more to the client to move the client along the platform. So in essence, I know that everyone has been focusing in the last 10 years in the fintech ecosystem into the concept of data-driven banking. I've got the data, I create the personalized insights, and then I shoot a marketing bazooka. That's wrong. That needs to be preceded by something which is more important. That means data enabling the client to operate on the platform. Otherwise, you onboard clients that will not generate profitability because they don't see themselves the value in being there and in self-directing, which in financial services is way more complicated than operating on e-commerce. So always take my examples with care, because I only make examples comparing e-commerce with banking where it makes sense, because clients behave very differently between the two frameworks. But the definition of value is the first one. And only if you define value at the beginning of the journey, you know how to digitalize that value. Otherwise, you spend the money digitalizing experiences that clients might be willing to do, but not pay for.
Right, yeah. That's a great example. And I think Amazon, you explained that Amazon example,
he was the only one to crack the code. Right. Then, of course, transactions are there. Then if you discuss Amazon is not a marketplace, it's a web service. But essentially, the question is, how do you crack the code of client motivation on your solutions on digital when they are there more or less alone? And then goes, and I might give the word to Huw. Embedded finance, for example, is one way of reducing the distance between the client motivation and the opportunity that can be found by inserting that more clearly into the context of their present journeys. Another one would be trusted advisory platforms like on the communication side. So essentially, the configurations that we're discussing here, especially embedded finance, is a way of reducing that distance. But only if you think in that terms, you get it right. If you only think transactions, you get it wrong.
Right. And the solutions are more personalized, right? And products are not central, and the customer experiences, right? And you mentioned Amazon example. One of the things that I can recall is, somebody asked Jeff Bezos, what's changing and what's not changing, right? And technology change, products change, but not changing is, the customer expectations. People want quality products. They want cheaper, they want faster, right? That's not going to change.
Take
Right?
30 seconds again. Some of my clients that build platforms like can be Bradesco for AgriFarm, or so in essence, they simplified the product to make sure that it could be consumed on the platform instead of in a branch. So banks tend to have a lot of complex products, but they're not fit for consumption. So the modularity out of the monolithic means the products simplify to their essential elements, and they can be rebundled according to what is needed in the user journey. So that's when the product in itself is not a container of the marketing and the profitability, but of course it exists, is an important element. But the value demonstration shifts somehow outside the terms and conditions.
Right. Thanks, Paolo. That's a great insight. So Huw, now let me come to you. You provide best practices, open banking or open finance frameworks, use case evaluation frameworks, integration models, and so on, right? So when we talk about the embedded finance business model, there is a problem statement or a customer pain point at the start that we want to solve, right? But we also want it to be financially viable, right? I mean, otherwise it's not sustainable. So in your view, what's a viable and a sustainable business model for companies launching embedded offering? If you can give us an example, that'll be great.
Yeah, and I'll perhaps start just by kind of building on some of the context Paolo outlined, because Paolo, I agree wholeheartedly with the economic challenges within the industry that's driven change. I also think alongside that there's been kind of significant challenge in terms of changing customer expectations. So historically, as you say, the banking business model was very vertically integrated. The bank had the license, the balance sheet, built the products, and they were hardwired into the bank's own channel, which historically was the branch. And that's kind of where we had that sort of monolithic organization. I mean, the banking industry's been going through a long cycle of digital transformation, which arguably it's still very early in that journey, because what they've been doing is decoupling the products from the branch and enabling them to be distributed through the bank's own digital channels, the mobile app and the online banking. But fundamentally, there's still an element of hardwiring going on. They've been building out the middleware and the digital transformation. But it's still essentially a way of viewing your statement and undertaking some simple activities in the bank's own channel. I think we're at a point of significantly more complex transformation right now within the banking industry. So historically, yeah, banks have been still a vertical supply chain, but going from a physical branch to a physical branch sitting alongside some digital owned channels. What we're seeing around the world now, and an absolute global phenomenon, is banks being either required by regulation or required by market compulsion. The reality is it's both, to actually expose products and services through open APIs, which enables those activities to be embedded in a digital journey somewhere else that isn't in a channel owned by the bank. I would argue that is a much more significant digital transformation than the banks have been going through for the last 20 years and spending billions of pounds on it. So I think it's a real sort of wake up moment for the banking industry. Some are doing it really well, and I think a lot still have quite a bit of work to do. I mean, as you said, Paolo, I think there's some great kind of models within the retail and the e-commerce world that banks can look at. As you mentioned, Amazon. I think Amazon are a great example for how banks can think differently. So, I mean, now far more than half the products that Amazon sell are on behalf of other retailers. They've become a marketplace where they understand the customer's needs and they can package stuff. And frankly, they don't want to manage the product lines for everything they sell. They don't want to manage the end-to-end value chain for every product. They want customers to be able to find whatever they need. And that's a model that works really well. Now, banks have got really, really well-used channels, and banks know quite a lot about customers. So if they can piece that together to more effectively anticipate the needs of customers. They can do far more in their channels and act as a marketplace. Now that's different than the embedded finance model. That's about banks doing more within their channel. But the flip side is banks have great capability. They've got strong balance sheet. They've got great risk management capability. They know how to manage payments and the risks. They can expose products and services through open APIs in a way that means they can be embedded in customer journeys in the right place at the right time with the right context. And another good analogy, I think, is look at Google Maps. Google built an amazing product in Google Maps. It is so pervasive because they made it available through a great developer platform. So it's now at the heart of your exercise app, your food delivery app, your ride sharing app. Almost every app you can think of has got some sort of form of location services, Google Maps, or something similar to it. And again, that's the opportunity for banks. What we're seeing, so we work with banks and financial institutions around the world to help them deliver open APIs in line with the right standards for wherever they operate. Now that's largely, that transition is largely being driven by regulators saying to banks, you must open up access to data. But I would argue that this is the biggest opportunity for banks right now, because doing a great job of that API layer will allow them to embed what they do. And this is about how banks can expose information that enables customers to unlock value in a third-party journey. That might be information that can be helped, that can help a credit decision. It might be enriched identity information that makes it really easy for a customer to onboard, and a platform, a marketplace, a third party will pay for that. It could be the ability to embed money movement, a payment. So again, a digital journey gets unlocked by embedding a financial transaction, the movement of money that allows a digital journey to go from search to complete. Or it could be embedding, there's a really interesting concept we're seeing in some of the open banking standards at the moment, which is service initiation. So you'll probably have heard of payment initiation, which is giving consent to a third party to initiate a payment on the customer's behalf. Service initiation is effectively the same concept. It's giving consent to a third party to initiate a service on the customer's behalf. That could be an account opening. That could be extending a new credit line. That could be opening an investment account. The things that really drive the P&L of a bank or a financial institution, what they're good at. So when it comes to use case, I mean, there are so many. Those foundations, we could talk about thousands of use cases forever. But if we think about the SME world, most SMEs now use, at least in a lot of markets, digital accounting platforms as the hub for managing the cash flow in their business. They connect their bank accounts. They can see the cash flow in and out. Increasingly, those accounting platforms are enabling them to do payables and receivables and help make sure they're paying at the right time and getting paid at the right time. That's a great opportunity for also, if banks are able to expose and FIs are able to expose the right APIs that allow lending to be embedded easily, you're in an environment where cash flow is understood better than anywhere else. So if you can embed simple lending solutions and payment solutions, then all of a sudden the bank can be at the heart of sort of cash flow financing, supply chain financing, payroll activities, bulk supplier payments, just through simple APIs that allow services to be initiated and payments to be initiated. So it really does create an environment where a bank can be far more central to a digital experience without having to own the channel. So I think there's some, we could talk use cases forever, but that's one example.
Sure. Yeah, I think that Google Maps is a great example, because the use case that I can think of banks embedding Google Map to locate the ATMs, they provide, if you have a bank mobile app, they provide the routes to the latest, the nearest ATM, right? So that's kind of embedding the Google Map onto the bank mobile app, so that you can locate, that's easy, right? Because many times we just search where is the ATM, right? And it's available.
I can see I can see Paolo's either desperate to build on what I've said or completely disagree with me.
No, I agree and compliment, because this conversation is very interesting, because this is all the beauty about digital embeddedness, but there is also a problem. How do you get paid for providing a service to Google Maps where is the next ATM? And that's where I want to add a needle element, which is important in the definition of value. And I sourced from two pieces of work, so you can go back and read. First of all, if you saw my latest research in IBM on embedded finance, creating the everywhere with the bank and the deposit makers, we interviewed 22 people out of a large sample, 1,000 executives, 12,000 consumers, but 22 execs from bank and non-bank. We asked them about how they monetize, how they implement, what is the correlation. And one thing that was defined clearly is that some of those bankers that were pioneering in embedded finance realized that it's not about the transactions that are created, but it's not about selling the API connections. It's about selling the use case, which is more complex. So participating in the whole use case value definition outside the turf of the bank. Okay. Why does this matter? Because my definition of contextual banking in banks and fintech or platform economies, which is the same of embedded finance, is that it is opportunity to eliminate an ecosystem friction that makes banking contextualized. That means embedded into third party to create new value. And I'm speaking like a central banker now. Every word matters. The end of the game is to create new value. So that means this value that happens somewhere else is not the value of the transactions. How do you define that? We go back to Amazon. If you go to page 162 of Banks and Fintech on Platform Economies, you see this image down here. This is the economy model of Amazon. And this is basically talking about the revenues and the operating income of Amazon. Now, if I ask you what's Amazon again, you will say it's a marketplace. Well, in terms of revenue, 88% of the revenues of Amazon come from the marketplace and 12% somewhere else. But when you look at the operating income, 60% of the operating income comes from Amazon Web Service and only 40% from the marketplace. So that means Amazon is not a marketplace. Now, that means that Amazon runs very expensive logistics that also need to embed financial services element to perform the marketplace. They might give them a chance, therefore, to position more value outside, which is the AWS. But that also means that for Amazon to consume embedded finance is a matter of reducing the cost of the marketplace. So that means embedded finance also faces a very strong commoditization challenge because it tends to become a race to zero prices. So of course, at the very beginning, there will be space in terms of volume, but in the end, it's about how do I contribute to the creation of value of that marketplace in a way that delivers the deal making, right? The contract I make with the platforms is as such, I participate to that value built and not just the individual transactional element. Otherwise, you build yourself with a dead end, right? At the end of the journey, which you don't want to. It's a more complex discussion to be had between a fintech, a bank, a partner like this one, but it's an essential strategic discussion to be had.
Yeah, so I agree. Just a very quick build, if I may. So, because we did talk about the business model. So, in that embedded finance scenario, you have to consider the business model on both sides. So that scenario I brought to life, so building lending into an accounting platform. The accounting platform side, the more functionality they can provide to their end SMEs, the more they're locking in subscription revenue and other value add and upsell revenue. They might get some incremental fees and what have you, but it's about driving their core revenue lines. So the more you can do within their world, the better. On the bank side, so again, if banks are exposing these APIs, I agree, this isn't just about a transactional model where banks get paid for use of APIs. I think there's a few business models here. So one second, if I may. We're working with a number of banks around the world who are looking at how do they now start to monetize open APIs. And what I say to them is, that isn't always the right way of thinking. So there will be some APIs where it absolutely makes sense to have a fee for use. So for example, if they are exposing enriched identity information that helps make a merchant's life easier, they'll be willing to pay for, I don't know, an age verification, address verification, an onboarding API. And we're seeing banks do that. We're working with banks to do that in Latin America. We're seeing the likes of NatWest do that through their bank of APIs. We'll see some great, I think we'll see payment for premium payment experiences. So variable recurring payments and things like that, that allow account-to-account payments to be embedded in different use cases. And again, I think there'll be a commercial flow around that. But actually, a lot of this is around driving the core banking P&L. So if you can embed an account opening experience in a third-party journey, you're not going to try and charge the third party for that because it drives your core P&L. It helps you get more customers, sell more products. So the business model, I think, looks different depending on the type of services and the use cases.
Then, Huw, I would even expand that one because it's very important. What is the business model of a bank? Risk management. Okay. So, of course, opening accounts or having more loans out there might add. But the issue is, how do you improve and manage your capital allocation? So now this is the story. When banks embed themselves into a third-party platform for lending, for example, they may access a population that is hard to reach. And sometimes they don't want to get the population because they don't have the information to manage the risk out of the population. But on the platform, there's different type of data that enables to understand and to segment clients differently from how you would segment them outside the digital platform. Now, a lot of banks I saw that pretend to build an economy model with their partners, being the fintech or the platform, that revolves around how many transactions or loans are generated. But in reality, their return on investment is justified if they can get the data back and they have a decision on how to embed those data into their risk management process to have a better capital allocation. That piece typically is missing. But that is part of the value that the banks can generate. Now, if they only think to be paid by transactions, they miss the point. When they conceive how they can use the data, now, it's not easy to use that data because they're not used to, because they don't have always the regulated framework for that and so on and so forth. But if they don't ask themselves the right question, they will never find the answer to the real problem. And therefore, they will always have a leg missing from the definition of business value that in reality is the essential element for them to thrive on a platform economy.
Right. I think it's a very interesting discussion on business value because that's kind of central to what we do in embedded finance, right? Because without value for everyone in the ecosystem, it's kind of difficult to find a viable business model, right? So now let's talk about regulation a little bit, right? I think we were on the topic of regulation. So when we talk about the open banking standards, at least in the early stages, that was driven by regulations. Right now, the regulations around data, which is GDPR or PSD2, the upcoming FIDA regulations from Europe, the CCPA in US, and regulations around the world around the data and open banking standards. Right. So your product caters to a large number of customers in different regions and different part of the world. So you work with a lot of regulations and regulators around the globe to make sure that compliance aspect is taken care of. Right now, can you share your experience or perspective working with different regulators in financial services area, and how do you see regulations actually helping startups in this space?
Yeah, it's a great question. I mean, obviously, in the financial services space, there's all sorts of different regulation around provision of credit and management of investment. So I'll talk specifically though about the open banking and open finance world, and seen a very significant shift in mindset from central banks and regulators over the last few years. So in Europe, open banking, the catalyst really was central banks and regulators wanting to increase competition for the big banks. And it actually created an environment of tension. The banks were pushing back and it took a long time to implement. Arguably in mainland Europe, implementation is still nowhere near good enough quality. And there was this sort of natural tension within the ecosystem because of the initial objectives of the central bank and the regulator. I think we've got to a good place in the UK now, but it's been hard fought to get there. If I look at the way other central banks and regulators are thinking now, the mindset has shifted massively. So I'll give a concrete example. We work with central banks and regulators around the world as well to help them define and implement open banking frameworks and standards and provide technology at an infrastructure at a central market level. And we've been very involved in the definition of open banking in Saudi Arabia, and we continue to be. It's really interesting. So the driver for open banking and open finance was part of a much bigger Vision 2030 to transform society and the economy and really kind of drive the kingdom towards a really ambitious future. Open banking and open finance was seen as a core part of that. Now, as a result of a big lofty objective, it was then designed in a way where it was focused around, and we worked through this process. So, okay, if these are the objectives, let's focus on the right use cases that will drive the most immediate adoption. So not to limit all of the potential use cases, but let's take a real use case focus to have the greatest impact on the industry and drive the greatest adoption with the users. It's still pretty early in the journey, but a really important thought process there was this has to work really well for the banks and FIs, because if it doesn't, they're not going to implement it to a really high quality. So the scope of open banking and the standards that have been designed to support that scope include far more than just the account information sharing and simple payment initiation. It is also going to include this concept of service initiation, which is being built into the standards. So from the outset, there's a standards-based way for banks to drive much more of an embedded financial services experience. It started with a simple product, which is a letter of guarantee, but the intention is that service initiation can extend across a much broader set of financial products. So yes, banks can enable access to information, which is powering a whole bunch of third-party and fintech propositions. Payment initiation has been taken to a whole new level in the Saudi Arabian standards, way beyond what the European legislative framework is enabling. But then this concept of service initiation, I think, will be a really important foundation. And every regulator we're talking to now are asking, what's best in class and how do we leapfrog it? So I think we're seeing much more of a shift in the regulator mindset to say, this has to really work for the industry. It can't be one side winning at the expense of the other, because then it's just not sustainable.
Right. I think we have seen that in India also playing out in the UPI world, where you have 2 or 3 players kind of having a lion's share, and then the regulators come in and say, hey, you guys need to reduce your share so that more players can come in, and we've seen that happening all over the globe, right? So that's an interesting perspective. Thanks, Huw. So Paolo, just coming back to you, when we think about embedded finance, right, starts with a problem statement and ultimately solves a customer pain point. Right now, we have the customer pain point on one side, and we have regulation, security, risk management acting as guardrails on that journey, right? And you've talked a lot about having an institutional approach where regulation can be an engine for innovation that can address the way the business models can change. And we can see some of the regulators like the Monetary Authority of Singapore, the RBI in India, having proactive policies and regulations that are helping the digital transformation journey, which has helped technology reach the masses, right? Now, how do you see that innovation and regulation go hand in hand, empowering not only the embedded journeys, but changing the way the end consumer or end customer experience that digital transformation?
Well, in my second book, Fintech Innovation, I remember there was a sentence at the opening saying regulation is the engine of innovation. And the founder of one of the robo advisors back then was the first to tweet about this book saying, is this Paolo Sironi crazy? What is he talking about now? Why regulation is the engine of innovation? Because thinking about banks, the problem is not technology. The problem is the incentives around the change of the business model, where you are asked somehow to leave a branch before you can grab another one, right? So the regulators have, wanting or not, this power. Sometimes they don't have the mandate. So the question is how they can make the right interpretation of themselves with the policymakers to facilitate the transformation on the platform economy of all the incentives around the new economy model, which is needed to generate value. Now, what is the issue and the thing that is to be resolved? Initially, at the beginning of this discussion, we talked about products versus outcomes, output and outcomes, right? Now, what is regulation for. Regulation is there to protect the client, the individual, the retailer. But how is regulation organized? Around the products that banks create, from time to time. So there is a gap here. So the issue is that also the regulators need to understand how to transform the perspective from regulating the products, the verticals, into regulating a framework on which the client has to operate. How to do so? Well, I tried to address this problem with my financial market transparency theory principle that I published a couple of years ago, which tries to define exactly those principles that enable to review regulation in a way you follow the client more than a product that is simplified more and more. Of course, there are techniques around all of this that needs to be considered where regulation becomes, if you like, a more technical element, right? But the principle needs to be clear in the mind of the regulators. So those jurisdictions where the regulators are more holistic in their perspective and understanding, they understand they are rebuilding an architecture around the client journeys. Those constituencies will see more clearly profitable business models that are generated on platform economies that don't fire up, okay, or fire back. The others will have to struggle because they will see fragmentation both on the institution side, the fintech side, and the regulated framework. And there will be a lack of competitiveness. So I believe that we are in a situation where everyone has to make a step forward, a step backward, or a step on the side. The financial institutions, the regulators, the fintech as well, in understanding their role into this marketplace, and overall, I guess, the policymakers, because this is intersecting the functioning of our modern economies, not just the opportunities for individual institutions, being banking and financial services so pervasive across the whole economic and social ecosystem.
Okay, yeah. I think we are kind of out of time. I had a lot more to talk about. Maybe if I can squeeze just one more quickly in terms of the future, maybe take a minute to see what's the future and the challenges. Each of you, maybe you can just maybe at one point, what's the future looking like and what are the challenges there? Just briefly.
I'm happy to start. Yeah, so I think right now embedded finance is the domain of some specialist product providers who have made products available with great APIs. It isn't yet the domain of the established financial institutions. I think they are moving in that direction, and I think they must move in that direction to remain relevant in a digital world. It can't just be that they only do business in their own channels. So I think the future is actually it'll be established financial institutions that get their act together and start exposing APIs that allow them to do this properly. It won't just be the domain of some specialist players that call themselves embedded finance platforms. There are barriers to get that, though. There's a lot of work the banks need to do to both from a strategic perspective and technically to get there. I mean, we're working with a lot of banks to help them on this journey of exposing great open APIs. I agree. I think there are some regulatory challenges and what have you. But actually, I think the biggest challenge right now is the banks really getting their heads around this and grasping that opportunity to expose what they do through great APIs, as opposed to just following regulation and doing the minimum to expose some information.
Okay.
If I can say on my side, I know that the last 10 years of fintech innovation has been around unbundling or breaking the banks. But those that know me since 10 years know that I've always advocated for the fact that fintech entrepreneurs cannot break banks for the simple reason that banks are already broken because they are divided into different silos. Now, the future is about bundling back on the platform economy solutions that need to resonate. Why is that? Look at the internet history. Platforms are the dominant players. LinkedIn is the platform for my business life, connected there. Facebook for my personal life. Amazon, where I sell my books, please do so. Twitter used to be the platform for my Trump paranoia. Now, for my mass paranoia, is always a paranoia platform. And I said Twitter, not X, because I don't want it to be the platform for my X paranoia. But WeChat is the platform of all platforms in China. So the question is, where is the platform that aggregates my personal, business, and financial life. That is in the future where we'll find the real unicorn that transforms the industry, nowhere else in the unbundled pieces.
Yeah, thanks, Paolo and Huw, and we are really out of time, but this is a very engaging discussion on the different aspects of embedded finance. We talked about the evolution, the business value, the business models, the use cases, the role of regulation in innovation of these journeys, and some aspects of what the future holds in terms of challenges and the opportunities, right? So thanks again for your time. I really appreciate you joining and sharing the insights into these areas. And just for the viewers, like the next panel, we continue our discussion on embedded finance from a technological and implementation standpoint. Please join that session at 9:30. That's Indian time, another 10 minutes or so. Thanks to Paolo and Huw. I had a great time discussing all these aspects with you. Thanks and hope to speak to you in the future also. Thank you.
Thank you.